The Chinese economy continues to grow a bit more than people expected, but not as much as the much vaunted 7.5% per year figure. Annualised, the growth for the quarter was 7.4%. Good or bad? Peter Tsai from China Spectator will tell us. How's it look?
It's actually slightly better than expected because the market thinks is about 7.3%, according to the survey done by Bloomberg. So it's much better than what the market expected, but a bit below the 7.5% official growth target.
So where was the growth coming from?
It's basically coming from the usual sectors. The fixed asset investment, which was up 17.7%.
That's infrastructure like railways and roads, etc.
Yeah, that's everything. And but it's down 3.3% compared to the same period last year. So we're saying that the Chinese government is taking the foot a little bit off on the accelerator, so they would not rely on a fixed asset as the growth engine. I mean, probably at least not rely as much as before. So that's one of the key growth engine, and also with the export sector, and we also see a decline in that, but it's still kind of a very strong engine for the Chinese economy.
Now, one of the big things people were looking out for was whether these numbers might suggest that another stimulus might come forward from the Chinese government. What do you think?
It's not going to happen. Sorry to disappoint investors out there. Is the Chinese premier actually did not rule it out just once, but twice in last month. And he said as recently as the BOA foreign that don't expect stimulus package to smooth out the fluctuation in the economy, and also just at the recently concluded Chinese annual parliamentary sessions, he once again ruled out the option. So we can expect some kind of focused investment in certain sector, for example, the railway. They would accelerate existing investment plans in like remote areas of China where the infrastructure is not as good as the coastal area. So we can expect some of that, but don't expect a large dose of a stimulus measure.
So some investment in railways, for instance, is good news for Australia's miners. But the other bit that I suppose is interesting is the idea that China is trying to rebalance its economy away from export-driven to more of a consumer one. Is that working?
If you believe the official stats, there's always a skepticism out there about what it means. But if you look at official stats, actually the service sector now accounts for nearly half of China's GDP at 49%. So it is actually the sign, at least we can think there's a trend is actually quite good. So that the economy is actually rebalancing in a way that the tertiary sector or the service sector is actually now half of China's GDP.
So we're looking at maybe more Chinese consumers, and one of the other things interesting out of the report was the increase in wage growth.
Yes, it's actually a very good sign that the Chinese farmers, their annual income increased 12% in the first quarter, and for the urban resident, they increased 10%. That's the good news. They have more disposable income, but the bad news is expect the Chinese technically it's called the Lewis turning point, because China is running out of surplus labor. Do expect to see the Chinese increase in Chinese wage may even have an impact on a global wage, because for a very long time the surplus labours in China help to keep the global wages inflation down. So yes, China's running out of surplus labour.
So it might be some good news for some Australian exporters of the more high-end stuff, possibly.
Yes, absolutely, given the increase in the wages.
Peter Tsai, thank you very much.
Very, very good to see you, Jackson.